Good morning, Flagship Harbor Advisors. Eric Jefferson with the core team. Happy Tuesday. Today is February the 22nd, 2022. Just a reminder, this replay is for advisor use only. Hope everyone enjoyed a long weekend. Probably a little confused turning the computers on this morning, seeing markets are virtually flat, slightly negative, up from some significant lows in early pre-trading, despite the headlines over the weekend where President Putin recognized two of the separatist regions in eastern Ukraine and advanced his peacekeeping forces in. The question now becomes, where do we go from here? Is this a pretext for a broader invasion? Is this as bad as it gets? Certainly the response from many in the West has been condemning the action as a violation of international law. We expect to hear from President Biden later today. He's talked about releasing the mother of all sanctions. We'll see what that looks like. Obviously, if the situation does escalate to a global military conflict, we would anticipate very significant downward pressure on risk assets. If this is as bad as it gets, though, one thing to keep in mind is that U.S. corporations have very limited exposure to both Russia and Ukraine. That's about 0.6% of the underlying holdings in the Russell 1000 have direct exposure to Russia, 0.1% for Ukraine. Obviously, something we'll continue to monitor very, very closely. One of the implications that we did discuss, not surprised to see that energy prices have buoyed very significantly, both oil and gas up over 3% today. And again, the headline there, Russia supplies about 40% of energy to Europe. So anticipating Europe to announce many sanctions, that will obviously put the supply demand metrics for European energy consumers out of whack. You saw Germany late yesterday come out and announce a halt on the Nord Stream 2 pipeline. Interestingly enough, the other side of that equation, US-Iran nuclear talks have progressed very significantly. If we do see those sanctions against Iran lifted, analysts expect about 1 million barrels a day to come back on the market. That will obviously have an impact favoring more supply, hopefully putting some downward pressure on prices. Turning to fundamentals, one of the things we talked about, again, as we transition into this year, different market environment, interest rates headed higher, don't have that booming, macro double-digit growth behind us as we play catch up from COVID. We talked about market now much more heavily focused on fundamentals. We're about 85% of the way through earnings season. Thus far, sort of right on track with historical averages. 77% of companies have reported earnings per share that beat estimates, although that beat rate of 8.5% is just marginally lower than the 5-year averages. So again, the interpretation there is earnings have been sort of right in line with the broader term results. The implications, interestingly enough, though, companies that beat expectations have been marginally rewarded. The big takeaway, though, is that companies that have failed to beat have been absolutely punished. Historically, companies in the trading days following a abysmal earnings per share historically have sold off just over 2%. We've seen this market punish them closer to 3% sell-off. So again, market is obviously looking for a reason not to own some of those riskier names that have offered poor guidance. And you're absolutely seeing that as we conclude the Q4 earnings season. Switching to the portfolios, one trade to discuss in the tactical core portfolios. Last Wednesday, right before the market close, we actually shifted our core equity holding from VOO. That was a broad-based market cap S&P 500. That was a position that we instituted to take advantage of what we believed had started to look like a bottom in the recent sell-off. With everything going on in Europe, we actually switched that implementation to PHDG. That is the Invesco Downside Hedged S&P 500 ETF. That owns a combination of the S&P and VIX call options. And the 2 trading days, Thursday and Friday, where the S&P was down over 5%, that position was marginally negative, translated to about 350 basis points of outperformance. And as we think about our overall portfolio positioning, so marrying the equity and the bond allocations, where we have had a more conservative equity allocation, we actually felt like we needed less protection on the fixed income side. And again, fixed income Generally speaking, duration as a hedge to equity volatility. We've played fixed income thus far year to date, underweight duration, overweight credit. That has been a very successful positioning by simply losing less. That wasn't great. Again, when we think about the role of bonds in the portfolio, is it to generate income? Is it to hedge volatility? But we didn't feel like duration was going to be that attractive of a hedge when we think about having a very strong labor market, when we think about still having record high inflation and expecting the Fed to take some very drastic action here. So as a result, we allocated a portion of the bond allocation into two currencies, the yen, which has in many ways replaced the US dollar as a safe haven currency play, as well as the euro in anticipation of higher interest rates that haven't been fully priced into the market yet. As well, we introduced a position in the short 20-year US Treasury bond. That was one certainly wish we implemented a little sooner. That has performed very well year to date. And really that is a play on rising interest rates globally, both domestic, again, for reasons mentioned earlier, do anticipate having a very significant rate hike environment this year. We're not all of that is yet priced in. The other part is thinking that duration doesn't really offer that much protection. So again, we would prefer to take a more conservative equity implementation, view our fixed income allocation as more of a total return standpoint. The other part of that, when we talk about global interest rates headed higher, as I mentioned in one of these earlier, as European rates start to tick higher, move from negative territory into positive, in many ways, we anticipate European investors to take their capital out of US Treasuries and invest in domestic bonds. In order to do so, they need to sell US Treasuries and sell the dollar. So again, we think that net selling puts further downward pressure on prices, upward pressure on rates for the longer end of the curve. And from an intermediate time frame, believe this position actually offered a fairly attractive risk return, total return profile. So that's all for now. As always, happy to discuss anything in more detail. Please let Michael, Meg, and myself know. If we don't connect, have a great week. Take care.